Even as stock markets reach new record heights, COVID rages on, jobs and livelihoods are at stake. How can booming investments exist with such bad economic conditions? And what is really happening? Will the global economy see a V-shaped recovery like what happened after the global financial crisis in 2008? Or will the current COVID pandemic see the same market recovery we experienced since 2009? Also, our SquirrelSave algorithms had a baptism of fire in the COVID crash of February and March 2020. As a result, our SquirrelSave machine learning AI has been tested under real conditions. Here how SquirrelSave behaved before, during, and after the crash. Where does SquirrelSave intend to invest your money in 2021? Should you wait or should you invest now? Without further ado, we invite Mr. Victor Lai, founder and CEO of SquirrelSave, to share his insight. Victor is a corporate entrepreneur with over 25 years cross-industry experience in investments, insurance, and healthcare. A chartered financial analyst and certified financial planner, Victor has a Bachelor in Economics first-class honors from University of Adelaide. Over to you, Victor.
Thank you, Gabriel. A good afternoon to everybody. We will probably take about half an hour plus to go through the slides, and then I would welcome questions and answers. So thank you very much for joining us at this live webinar. First, some disclaimers, and this is a bit of background about what I've done in investments, insurance, and healthcare. And today I'm very happy to share with you my views on the outlook for 2021. Let's take a look at the state of play. Very clearly, investor confidence is rising despite the raging pandemic. And as you well know, if you are an investor or even paying attention to headlines, the US markets are hitting new highs, vaccines are being approved, and Moderna's vaccine now is approved on an emergency basis. Our Prime Minister in Singapore has also announced how Singapore intends to distribute vaccines. What is also very important is one major uncertainty as to who will lead the United States is now clear, with this Monday, the Electoral College confirming Biden from the Democratic Party as the president-elect of the USA. And if you look at the global economy, we're happy to at least see that there is a recovery. But I say it's off a low base, so it's expected, but I'm watching the pandemic situation closely because anything can still happen. In terms of data, for which SquirrelSave's algorithms are very plugged into, the data is showing that the Manufacturing Purchasing Managers Index, or PMI for short, is rising in major countries which are suppliers, such as Brazil and India. That's good news. We also look at service sectors because as the economy matures, services becomes more important. And the USA and China are showing good signs. Importantly, across the whole world, and for Singapore particularly, as a small little red dot and island state that relies on trade in connecting to the world, the data is showing that trade is rebounding, which is good. But again, we need to be watching the markets very closely. Further, we cannot deny that the COVID-19 pandemic is not resolved. It is not going to go away in a few weeks or in a few months. We think it can persist into 2021 and maybe even into 2022 if we don't do things right. This is the worst health crisis we have seen since the Spanish flu of 1918. And to many of us, we've never lived through such a time. Also, most of us would remember 2009, 2008, when the world was plunged into crisis due to the mortgage subprime crisis that started in the USA and spread across the world. And the economies contracted, jobs were lost, and so on. But that was different. and the money was pumped into the banking system, and the banks were deemed too big to fail. And as a result, there was a recovery in late or middle 2009. But since 2009, 2020, this is the worst and even bigger drop than what we saw in 2009. It's very bad. And for those of us, your parents, grandparents, they lived through, particularly grandparents who lived through the Great Depression, this 2020 is the worst since the 1930s Great Depression. We are also seeing great changes going on, politically, technological. The empires of the old past, colonial powers, have given way to the new economic, multilateral, multinational companies and institutions. But today, we argue there's a leadership change in space, in technology, that we have seen and benefited from. But it is accelerating this race. If you look at China alone, innovation is tremendous, arguably overtaking the USA. Example, you would know, especially if you're a teenager like me, TikTok is in the USA. And you can see the tensions that it's caused. The China internet market is over 1 billion users and very connected, even at some stage, more advanced than Singapore. The point is, China alone outnumbers the USA and the European Union combined. Therefore, in terms of technology, in terms of space, China can do it on its own. So this is a space to watch. And for us as investors, it means something. However, into 2021, what will affect us will be geopolitics. There is a new strategic warfare. People are testing each other. When I say that, I mean countries and powers. And we have to watch like little ants as elephants jostle. For example, if you look at what's happened recently between India and China at the line of actual control in the Himalayas, that's not something we can just say it doesn't matter. It does. If you look at the tensions that's created through proxy countries, say Taiwan, between China and the US, there's a lot more we can talk about in a single separate webinar on that. The tensions between Japan, China, Korea, for example, China, Australia. And of course, all of us read in the headlines because that's what we are asked to read, is the tensions in the Middle East. There's some peace overtures, but the tensions remain, the alliances are fraught, and you've got China that's in the background here, but you've got the US, you've got the European Union and Russia in the Middle East. And nobody talks much about it. Africa, where China is present as well. So we can see what's happening in Central Asia, Eastern Europe, tensions inside NATO. So is it NATO versus Turkey, and Turkey is a NATO member? And in the recent conflict between Azerbaijan and Armenia, where you've got proxies between Russia and NATO and Turkey, these are things that we need to watch as smart investors. In the post-COVID world, I outlined a few things that we can't fight. Digital is now going at warp speed. The fact that I'm doing this webinar and more often is also a sign of that and how we will change our behavior. The future of work is at stake. Already, the pandemic has hit traditional industries, and people are now trying to shift and adapt to this new post-COVID-19 world. So work will no longer be the same. It was already going to be like this because you can read about how AI is going to change and remove jobs, opportunities. But now things have accelerated because of COVID-19. It's a game changer. Particularly, countries are now realizing the old argument that we depend on a country that is good at producing something to sell it to me, and I focus on what I'm good at, it doesn't hold anymore. So we can burn our economics textbooks, but we need to apply new lessons that countries are going to think about localizing some of the strategic essential items rather than to depend on someone else, because COVID has shown that when you need that item, they may not be friendly to you. There is increase in inequality between the poor and the rich, and arguably the rich have become richer if they know how to invest. But the poor who have no access to finance and have to work from hand to mouth, COVID-19 has destroyed and caused a lot of hardship. All of this means that the world economic system is being reshaped before our eyes. As investors here today, what do we do about it? So let me break it down into 4 simple, broad parameters that I look at. I look at more, but here I simplify it into 4: geopolitics, economics, monetary policy, and fiscal. Fiscal meaning government spending. And in 2020, you can see on my screen, all right, 2020, if it's red, it means very high risk, problems. If it's green, we're in a good situation. But all 4, we are not in a good situation. Geopolitical risks in 2020 is high. It could go higher. Economic risks have risen to the top because we have overnight forced closures of our economy, restrictions on movement and travel, on trade. On the monetary side, it's terrible. We are starting to print money, and I will show in the next couple of slides why it's worse than 2009. But yet, if you know what's happening, we have a way to make hay while the sun shines. And that's the key. Fiscal risk on governments, it's bad, and I think it may get worse. So I'll explain. So what are we thinking about in 2021? And here I'd like to lay a disclaimer. I do not know. This is my educated, analytical guess, but it's not plucked out from the air. On the geopolitical side, what we know is that Trumpism has now ended, but it hasn't gone away. He may come back. And what he has done is not all negative. He has pushed for US sufficiency in oil and gas, but that distorts markets. He has reduced troops based overseas, but it creates new tensions. There is support for Israel and Saudi Arabia in striking peace agreements, and we welcome peace among peoples all across the world. But there is a price to pay. And if you look at the US policy of US first, all right, it has weakened the global framework for cooperation. And they're targeting new enemies as a result. And China is in the gun sights. There is resistance against free movement of people and legal movement of people even. So these are all the issues that Trump brought. With Biden, what are we looking forward to? Well, uncertainty will remain. The Georgia runoff for Senate is still going on. So we will know what the situation would be in terms of the US Senate. We are looking at how the armed conflicts in the Middle East, in Afghanistan and so on will pan out. How the tensions I mentioned earlier will be managed as a global cooperation rather than as competition. Will Biden negotiate with Iran? Will he go back and strengthen NATO? All right. All these will have implications for us as investors. But what is very clear is that the rise of China is not reversible. It's more than a generation. If you know the history of the world and the place of China, this is irreversible. We know about the BRI, the Belt and Road Initiative, and we all know about the US-China tensions. What is interesting to share with you is that China is a major player in very strategic commodities. And it is here, I suspect, that the quiet fight will be in terms of steel and aluminum resources, not even mentioning rare earth minerals, where China has a huge advantage. In terms of technology, you will need those minerals. These US-China tensions are going to be centered around trade and technology, and it will move from air, land, and sea into space. And that's what we will see more of in 2021. Rocket launchers will be like you in the old days going to the airport and taking off in an aircraft. Who would know then that we'll be taking airplanes like buses until COVID came along? So how will this US-China tension play out? Well, clearly, China is racing to build its military, and it also means worries for us as investors, as tensions need to be managed. In the markets, there will be fight for strategic power. The EU is pushing back against big tech and trying to break them up. Here, locally, we have got local issues like Gojek and Grab trying to muscle together, creating social tensions in the people who depend on these companies for a livelihood. So there are many, many macro and micro trade technology tensions that will affect the investment markets. What we will see, though, is that we will be more local, less global. So this will bring about a more geopolitically polarized world. It will potentially lead to a misallocation of capital and resources, and that's not good for Singapore. And we would see more competition to fight for taxes and non-tax regulation. So what do we do? So that's geopolitics. Let's look at the economy. You know, the economy goes up and down in cycles. And here you see a diagram about how the economy is in a stage of repair, recovery, expansion, and downturn. So hopefully we are moving from downturn to repair right now. But it will take time because of this pandemic. It's not a normal situation. As I mentioned, as I opened, this is the worst economic depression since the 1930s, the worst health crisis since 1918. So be patient, take the long view. Be careful if you're trading or speculating, yet you think you're investing. So vaccines are on the horizon, but it will take time to distribute. The vaccines must be carefully handled. Some must be stored below minus 30 degrees Celsius. Many countries don't have that. So it's not a silver bullet. Organisms can mutate. Vaccines may have to keep up. Supply chains can be open and then closed with what you can see now with the resurgence in Hong Kong, Korea, Japan, which were once quite under control. Employment is being disrupted. Locally, as the Singapore government, we're doing a lot, and we can do a little bit more. But really, we need people to realize it's no longer the same game. We need to adapt. We need to change. We need to embrace technology in the old things that we did, including how you invest. So at the household corporate debt, it is high, and at the government level, it is even worse. So let me talk about it. At the monetary policy level, many of you may not understand unless you're economically or investment or finance trained. The risks are terrible. Here, you look at the Fed, the amount of money they printed in 2020 far exceeds 2008, 2009, when we thought that was bad. It is even worse now. They've printed so much money, they're literally dropping money out of a helicopter onto the streets, where every resident in the US gets X dollars in check. And now they're going to do a second round, which has just been announced. So the government is using money, printing money on the monetary policy side to try and stimulate the economy. But guess what? All it's done is that the US government debt has shot through the roof. What they have chalked up in terms of debt in 10 months of 2020 is equivalent to what they did for 20 years, between 76 to 1996. It's scary to me. You may not be aware, but it means we better be very smart in how we invest from here on. And let me explain, this monetary policy, this printing of money, has led to fiscal risks on the government debt side. Government spend, they tax. They can't raise taxes. They cannot raise interest rates. And yet, they have to stimulate the economy. So what are they going to do? Rates, as you know, are pushed down to near zero. The Federal Reserve USA just announced they'll keep it at near zero. Where's it going to go? The truth is, with the amount of debt that the government has chalked up by printing money on the money side, the Fed cannot increase interest rates to push the economy up, because every percentage point rise in interest rates will increase the money the government of USA has to pay as interest. So you can see on the screen, there is a $27 trillion debt. The US economy is only 21 trillion. The debt to GDP ratio is almost 140+%. This is very serious. Never in history have we seen this kind of numbers. Never in history. And the interest they have to pay will be close to 1 trillion if interest rates go up. So how do you stimulate the economy with government spending? We don't know. But there are three possibilities I'd like to share. First, the Federal Reserve can continue printing money, trying to inflate the economy as to devalue the US dollar. So the US dollar will buy less. And therefore, to repay the debt, it's very cheap. The second one is the US government can say, I'm not going to pay you back. And thirdly, which I think is very interesting and likely, they will, instead of having zero or a positive rate, they will start saying to you, if you keep money in the bank, you think your money will grow with 5%, 2% interest. No. Every year you keep your money in the bank, it will reduce and become smaller until it becomes zero. So negative rates are what I think are possible. But it would require technology, which we have. And even in a separate webinar, we can speculate and talk about the rise of cryptocurrencies and central bank digital currencies. But that's another day. The truth is, with technology and crypto, people are beginning to realize that we can now apply negative interest rates on who we choose and limit what you can buy or sell with those digital currencies. It's scary, but I think all these things that are happening that I'm observing are leading to that acceptance that we have no choice. Everyone needs to plug into the system or you can't buy or sell. How long? Well, I don't think it will be in the next 5 years because I think it will take a massive crisis to force those who resist to accept. So back to my 4 drivers for 2021, geopolitical risk is going to go up. Economic risk, is going to improve. That's green. Economic risk is going to improve, right? Because you've got Biden trying to cooperate globally. We're recovering off a low base. The problem is on the policy side. The monetary policy that I mentioned, the printing of money, someone has to pay back that debt. And the government spending is going to limit government's ability to stimulate the economy. So they have to find some new ways. So as a result, what do we do for 2021? What is very clear, as an investment professional, the United States remains dominant, okay? Notwithstanding what I said about China. In global investing, the US markets accounts for the majority. And many of the companies listed on the US markets actually are not US companies. They have become global companies. So if you look at some of the big 5 companies that I mentioned on the screen here, the S&P 500 in 2018, the latest data I can get, 43% of all revenue comes from outside US. For Apple, Facebook, and Alphabet, more than 55% of their revenue is outside US. And for Microsoft, it's about half. So like it or not, many US companies that I talk about, and when I say the US market, actually the US market reflects the global market to a large extent. So one thing in terms of asset allocation, we, using our machine AI, is likely to allocate a large portion still to the USA. So what now do we do that we have a recession, inflation is not coming back, and government debts are all-time highs? Well, one thing is clear. My training in economics is useless because these are uncharted situations, and we're all talking in theory right now. So a lot of things are questions. Can Biden push through fiscal stimulus? Can COVID-19 be tamed? Will central banks remain supportive? Can rising fiscal global debt be digested and paid? Will inflation go up but not go out of control? And can China play the role in pulling the world out of this recession, like what the US used to do, but now the emperor bracket US, has no clothes on. Who's going to tell him that? With multilateral economic contraction, can trade resume, and will trade wars ease? A lot of questions. Then we ask things that we don't know. Will there be a continued US dollar adoption? Or will people say, I'm no longer going to play the US dollar or accept it? That's a black swan, right? Will cryptos come in and replace certain currencies? We don't know what we don't know. But the markets are, we will focus on the US, like it or not, it still has outperformed in 10 out of 11 years. Valuations are crazy, but we have no choice if we still want to invest. We may, however, shift some allocation out of the US because it's done so well to other parts of the world, and primarily Asia, where the growth really will be, led by China as a locomotive. We will be watching the UK and its relationship with the EU post-Brexit, but I still think Asia will look more attractive, and in general, emerging markets will look better. So what do? Remember, I've done this at the previous webinar. Diversify, because none of us are smart enough. Diversify is the only free lunch. And what do we do in diversifying? Take advantage of upside, protect the downside. COVID has accelerated digitalization. Are you taking advantage of it? And I mentioned, in investing, we can now use technology and AI and data. There are too many things going on. No single person can call it right, including me. I need a data system that is monitoring data 24/7, which is beyond human capability. And that's why it's called AI. We know that Asia and China has rebounded faster. All right. So where do we put our money? Diversify. We'll put some in Asia. All right. And you need to focus on risk-adjusted returns. And to manage risk, you diversify. We have three scenarios: a base case, all right, an optimistic, all right, and a pessimistic case. And now AI is at work. So take advantage of AI while we have it, because we have it. And it's only just arrived. It's not a long time being there, but in the last 5 years, I argue data is now available. Take advantage of it. So SquirrelSave, which I founded, makes global investing easy. We use AI. You do not need to have a lot of investment knowledge. You don't even need to be an adult. Your parents can invest for children, right? And children have the longest runway to invest. No day-to-day decisions to make. You can start from $1, yes, and just know yourself. So I mentioned AI. I'm going to share something on screen with you. So Gabriel, shout out if you cannot hear anything, but there's not much to hear. What you see, take each system, 1 and 2. I tell you, hundreds of thousands, if not millions birds. Every bird wants to find a target. 3 dimensions. But they have to fly together as a group. And everybody is trying to predict where that group is going. But guess what? That is a good way to illustrate how our AI looks at the market. In the study of birds like starlings and their movement as a Mermuration. So you have a herd of goats, all right, a litter of pups, right, a flock of birds. But for starling birds like these that form a cloud and shifts, we call it Mermurations. So it's a new word for you. It's a science in mathematics where we use mathematics to predict where this density, where you see darkest, will go in 360 degrees, 3D. So we now can map every bird as if it's a stock or a piece of price of a data and understand where the market is heading. And I just wanted to show you that's the kind of technology we have now. Introducing Mr. Starling Bird, and he's our motivator in using AI. Now, let's come back to the final section. What has our portfolio done In COVID-19, I had a chance to test and prove how our AI system will behave when there's a crash. And prior to COVID-19, we did not know it was coming. Many professional colleagues and investors question if AI can do better than humans. Well, humans can bet and pick something out better than machines. But humans cannot do better than machines in being consistent, unemotional, and fixated on data. And we use that data using machines to manage risk 24 times 7 because humans need to sleep. And the US market is still where the action is. And that's our bedtime. So COVID-19 gave us a chance to showcase how our machine actually behaved. And I'm happy to show you. COVID-19 caused the market to crash from February 19th, 2020 until 23rd of March, 2020. Now we can tell with 2020 hindsight. As a result of that crash, the S&P 500, the biggest market, dropped 34%. During the same time, our reference portfolio, our first portfolio that I set up on the 1st of June 2019, I was the guinea pig. I tested my own system. This is my portfolio. I'm the first customer of SquirrelSave. I put in a $15,000 portfolio and tested my engine from June to August, September, and then people could really invest towards the end of August 2019. And this is my portfolio. It's lived long enough to show you it's not a flash in the pan. It grew from June 2019. It survived the crash by dropping only 10%, when the US market dropped 34%. Thank you, Mr. SquirrelSave, for diversifying for me. But not only that, what's very important to tell you is how it recovered. Within 3 months, as the markets recovered from March 23rd, which was the bottom, all right? The S&P on 18th of May was still 14% below its peak. My SquirrelSave portfolio, my portfolio was only 1% below the peak. So in other words, not only did SquirrelSave protect my downside, it also pushed me up very quickly compared to the US market. So here we can show you how our SquirrelSave behaved during a crash, a real crash that nobody knew. And you can read more about it by going to squirrelsave.com.sg and read my blogs. And read when in March I told people, as people were scared, I said, I learned enough that this is a time to invest. If you did, you'd be happy. But guess what? It is now 17th December 2020 that I can show you that same portfolio that survived the crash. What is it doing now? It is a very aggressive risk profile, and it was set up on the 1st of June. It's got 19 months of track record now. It's up 22% in 19 months. If you annualize it for 12 months, it's 14% per annum. Is that bad? I think it's decent compared to my bank account, which is giving me less than 0.2%. So the machine works and it's performing, and I'm happy. I'm not looking for the highest return in the world. I'm looking for good risk-adjusted returns, decent. And on the right, you see it's well diversified. As a human and as a professional fund manager, I can't have possibly done this on my own. Only AI can do it. And we've designed it in SquirrelSave. And guess what? You don't have to put 15,000 if you don't want to. Your returns will be less because you can start with $1. And here I show you a $1 portfolio, also 17th December data. It's a conservative portfolio. And we started this 18th May after we realized that markets have recovered. Let's try it out. What will SquirrelSave do? And in the last 7 months, SquirrelSave has returned 5%. So if you look at it here, let me get my pointer out. It's a $1 deposit. It is now $1.05. 5% return. 5% return in 7 months. That's equivalent to 8.5% for the full year on a conservative portfolio. So I'm not even taking the maximum risk. It's still 8.5%. And how did we do it? We diversified, because you can see on the right-hand side, it's well diversified, $1 spread across 11 asset classes. And again, it's not possible as a human to manage a portfolio for $1. Not possible. AI can. Now let's look at a more aggressive portfolio. It was started on the 5th of May, 7 months now. It's up from $1, as you can see, $1. It's now $1.11 after 7 months. That's an 11% return or 19% annualized. And it's again diversified, well diversified to manage risk. So this is SquirrelSave. And that's the end of my webinar for today. Thank you very much. And I welcome questions. Thank you.
Before we open the floor for questions, we'd like to also make some general announcements. So if you are looking to invest, why not invest in SquirrelSave? Be the first 5 to top up or deposit $20,000 in fresh funds into your SquirrelSave account and be rewarded with a brand new Fitbit watch worth $258. Now, let me just show you how the Fitbit watch looks like. So be the first 5 to invest in fresh funds or top up with $20,000 into your SquirrelSave account and be rewarded with this Fitbit watch worth $258. Terms and conditions apply and promotion ends 31st December. Okay, so after this announcement, we're going to open the floor for questions. Okay, Victor, over to you.
Thank you. Let me then address the questions. I have a question is, how do you explain the disconnect between Main Street and Wall Street? Well, it's very simple. In traditional economics, when we print money, all right, we're trying to get people to spend the money. So if you spend the money, you would buy more goods and services because we want the economy to rebound. And when you have more money chasing the same amount of goods or services, or even less because as factories close down and so on, the price of goods will go up. So you inflate the economy. And as you inflate the economy, people are afraid that if I don't buy now, it'll go higher. And then it's a way to get the economy back up running. It's like jump starting your engine. Unfortunately, thanks to technology, people now can trade from the comfort of their homes and they can trade anywhere in the world. So what happened was the free money that was printed ended up mostly buying financial assets. So there was inflation. So traditional economic theory worked. It's just that it didn't go to goods and services that you can hold, that you can consume, that someone has to produce. Instead, it went into unproductive financial assets, which is like buying a piece of paper, which doesn't require someone to be employed, except in the financial markets. So that is the disconnect between Main Street and Wall Street because of technology, because of accessibility to capital markets. Now, if you take 25 years ago, when I first started investing, we had to use a telephone to call a broker. And the broker say, who are you? I need to know who you are. So I've got to go and meet him. And even then, I've got to give him my salary slip. It takes days to print and so on. And then he has to confirm that I have the money to invest. Today, you can open an account like SquirrelSave within 5 minutes. And people are doing it across the world. So people are now investing as though they're working. So this is a problem. This is a disconnect. And it's not sustainable. And that's what I alluded to in my slides. The other question is, your risk slides show high risk, yet the market, especially at all-time high. Yes, what I explained, there's a lot of cash and it's inflating assets. So what we are seeing is nominal values, but the real value has remained the same. So the extra money that's printed is just going up to increase the nominal price of the asset, but the real value of the asset hasn't changed. So what's happening is that you need to know when to get out. And that's a trading mentality. I'm bad at it. That's why I do what I do. If I'm good at it, I don't need to manage people's money, would I? So think about it when you put money with other fund managers who take your money and bet on your behalf. They don't know better, except that they've been doing it longer than you and they do it every day. I have decided that I will use a machine who will not use gut feel and self-pride and ego to make decisions. I use machines to look at what's happening, to recognize patterns, a la the Starling bird, shapeshifter clouds, and they will then predict where the markets are headed. And if they get it wrong, these algorithms in real time can correct themselves. And that's called machine learning. So I can do the math, but by the time I tell you, game over. But our computing power is doing it in real time. So I think the markets are high in terms of risk, but there's still money to be made if you can use machines. Someone mentioned that the US will not go into negative rates versus Europe. Well, let me put it this way. I'm not saying they're wrong, but let me tell you, when I'm a policymaker and I need to influence you, I can do two things. I can give you some signals, or I can actually do the policy. But if you do the policy, you shock the market. So what we do is we talk the markets up or down and manage the markets to a soft landing to avoid hard landing, right? Would they tell you what they really think? So that answers the question, because the question was, will the US go into negative rates if the US Fed has mentioned that it will not? So what I'm saying is people can say what they want, but we look at data. A question, what is the difference between SquirrelSave and others like AutoWealth and Diversify and so on? The main difference is that we are completely AI. That's the first point. The second difference is that we have a full retail asset management license, and we actually manage the assets, whereas some others are actually financial advisors. They advise you, but they place the assets with someone else. So there's a difference, but I think there's room for different kinds of players. But I strongly believe in setting up a smart portfolio, and if you can keep your money managed that way, and you've got extra betting money, yeah, get a human to manage it, or a financial advisor, or a professional fund manager to manage actively. But you can go and Google the data about active managers. The data done by universities who are not involved in the business clearly show that no active manager has consistently beaten the markets. Okay, so I leave it there. Our fees for SquirrelSave, that's a question, is set at 0.5%, 0.5% of your amount invested flat, whether you invest $1 or 1 million, all right, flat. If you invest more than a certain amount and you think it's big, talk to me, I'm flexible. For big amounts, I can go lower than 0.5%, all right? But it is 0.5%, and we are different from the others because we charge a performance fee, because I strongly believe in aligning our interests and aligning it with the client. You are here to make money as well, right? So if we make some money, all right, the performance fee makes sure that we design our algorithms to generate as much return as your risk will allow, so that we are incentivized. And we only get paid when you make money. We don't take it from your money up front, not like some traditional products like unit trusts where there's a front-end sales charge of 3% and so on. We don't, all right? So that, I hope, answers that question. Yeah, another question is, how safe are my funds with you? The answer is safe, because we are regulated by MAS and we comply with regulations, which means all your monies are not kept by us. All your monies are kept by our custodian, and it's a full licensed bank, all right? If you read our terms and conditions, you'll read that it's actually UOB Bank, that's our custodian. So all your monies go into UOB Bank, and we then use our algorithms to tell your portfolio what to do, and the instructions go to UOB Bank, and it goes to the markets, and your assets are also kept separate from us. So we cannot own or take your assets for our spending on the rent and so on. That is separate. So we are quite okay. And someone asked me in the last webinar, what happens, touch wood, something happens to SquirrelSave? Your money is safe. Your money is kept separate from us. Whatever happens to us, your money is there. You can take it back. All right? Thanks. I think that's all the questions I have.
Okay, so we have, is there more questions from the floor? So just feel free to ask. In fact, we only just have 2 more minutes left before we conclude today's webinar.
Okay, I think everyone's probably going off for their lunch. So have a good day, and please stay healthy. And let's pray that the world can come together and that we have a better 2021. Season's greetings to all. And for believers and so on, take care and pray hard.
Okay,
Good
thank you
afternoon
so
to
much,
all.
Victor, for today's webinar. And also just one final reminder, if you have, you like to invest in SquirrelSave, do take note that we have this promotion for Fitbit. So if you have $20,000 worth of fresh funds or top up in your SquirrelSave account, you'll be the first five to top up the funds and receive a Fitbit watch for $258. Terms and conditions apply. So thank you so much for today. And thank you to Victor for taking your time off, and also to all our guests and all our attendees for taking your lunch time to join us today. We'll see you again in our next webinar. Goodbye.
Thank you, Gabriel. Thanks, everybody.